there's some room for this market to get some legs underneath it. But, we've got some work to do. First of all, we've had basically, 8 straight months in a row where markets have been positive. That's a very long stretch. So, having a month or two where you get some consolidation or a bit of a contraction even would not be surprising at all. Say the last half of this month, we have a 3 to 5% correction for, whatever reason. That would be totally unsurprising given this massive run we had from those April lows. You should expect probably this year in 2026 at least 2 5% corrections and probably a 10% sometime this summer would not be surprising at all.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap with my good friend, the done and dusted portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing good. Very excited. Next week, of course, when we're having this conversation on air, you and I will actually be in Houston for our investment conference. So we've got 1 week left. We've got a few tickets left available on the website. So if you go to realinvestmentadvice.com, click on the link at the top of the page and get your ticket. Love to see you here. We've got time to visit. Adam and I both will have plenty of time to visit, hang out, talk after the conference. So if you haven't got your ticket yet, be sure and do it. It'll be a really good conference.
Yeah, should be really fun. Looking forward to doing this market recap with you live next week in front of your live audience. So folks, if you're watching and able to get to Houston next week, please join us. It's going to be a great time. So Lance, I chose done and dusted because your wife's chemo treatments are now behind her, correct?
Exactly. Yes. Very excited. All the blood work has come back exceptionally good. So her CA 125 is down below 10. Now it's at 9, which is one of the tests. Normal ranges are up to from like 0 to 30. So she's well into normal ranges, which is fantastic. I told you about the singularity test, which showed no evidence of disease. So she's done really good. She's just recovering now. The last chemo was Friday, so she's just now starting to get past the nausea of that. But she's very excited. She's starting to grow back hair, so she's very excited about that.
All right. Well, look, we are super excited for her and for you that the news appears to be developing so nicely. I know you're not out of the woods for
Oh no.
years until, they clear you, but how fantastic that things have been going the direction they have been and so wonderful. And I really look forward to giving her thanks from everybody from Thoughtful Money in person at the conference next week.
She'll be there Friday night for sure for the mixer. So she's looking forward to seeing you.
All right, fantastic. Well, and Ashley, my wife, is coming too, so she's looking forward to meeting her in person as well. All right. Well, look, lots to get through and not a lot of time.
Yep.
Lance has got to get out of here for another checkup with the doctors there. So we'll get you out on time here, Lance. A lot to cram in here. Hopefully, a rant that might not even be a short one. So we'll see if we can't get it all in, and if not, we'll make changes on the fly. First off, folks, forgive me if I look a little peaked. I got in real late last night. Investing in one of the most important things, which is your social capital, your community. As folks know, I moved to Reno this year and got invited to my first guys poker night last night and didn't crawl back into the house until quite late. So I'm recovering from that. What I did learn most from this, Lance, besides that there are some really great guys I hadn't yet met that I got a chance to spend time with last night. But as you learn during events like this, the power of alcohol and luck is just amazing. As folks know, I don't drink, so I have no excuse for performing poorly in things like poker. But the guy that just cleaned the table, Lance, just got drunker and drunker through the night. And he started amassing so many chips, he could kind of push people around. But he got to the point pretty early on where he wasn't even checking his cards. Playing Texas Hold'em, so you get dealt 2 cards right at the beginning. His big thing became like, I'm just going to bet and I'm not even going to look at my cards. And this bastard just kept winning again and again and again. I kept waiting for reversion of the mean to kick in, for the alcohol to really kick in. And this guy just cleaned the table until his wife came and took him. And then we divvied up all his chips because he had all the chips at that point in time. So anyways, It's always a caution of, if you're sitting at the table and you're feeling like the patsy, you probably are. And I definitely was last night. All right, so lots to get through here, Lance. Let's start with the markets. Everybody is feeling the tractor pull to the big round number of 7,000 S&P, but we haven't quite hit it yet. And last time you were on, we talked about that you were seeing some healthy rotation, some broadening of the markets. Is that what's continuing here? Is that sort of what's keeping the Mag 10 from pulling the S&P to 7,000 because capital is starting to flow in some of these other sectors that have been less loved?
Well, it's actually the Mag 7 that's keeping the index from getting to 7,000 because they've actually kind of been underperforming. Apple, Nvidia, Google, Meta, they're doing okay. There's nothing going wrong with them, but they're just really not going anywhere.
Right.
So
That's what I'm saying because the capital, I think, is flowing into other
yeah,
parts, right?
yeah, right, right. So, yeah, what's been supporting the market here is we're definitely saw, in fact, I'm writing about that in this weekend's newsletter, um, which is part of the discussion is looking at value versus growth, and value has been outperforming growth now for the last few weeks, and in fact, just last week on the first trading day of January, we launched a new factor rotation model on SimpleVisor. It's an actual live dollar portfolio. So I've actually got capital invested in this portfolio. But it looks to rotate between value and growth. And right now it's about 80% value versus 20% growth.
Really?
Yeah.
Okay. So this is new, but you think this is apparently going to be an important enough theme of 2026 that you've committed real capital to this?
Well, no, we've been so Nick Lane, who is our one of our CFAs on our investment team, has been researching this model for about a year and a half now. We've been back testing it in a whole variety of different manners. No, this is a long-term portfolio. It's not something that we're designing just for 2026. There is a long history of value versus growth rotations, and in fact, if you put a value chart up against a growth chart, they're almost mirror images. And there are times when growth outperforms, there's times when value outperforms. And so, what this model looks for is it looks for relative changes to that correlation between value and growth. And then it rotates the portfolio between 80% growth or 80% value based on those changes. So,
When you
it's
say rotates between 80%,
Mhm.
is that in gradations along the way, or is it just 80 one way or 80 the other way?
No, it's in gradations. As we
Okay.
start to see the relative performance pick up, we start migrating over. It can happen very quickly, mind you. So this portfolio isn't for tax sensitive people because it can have a lot of turnover within a given year. But over time, the value versus growth relationship works out well and provides better performance with a lower beta volatility than you get just in owning an S&P index.
Okay. Um, how what are your expectations for how active it's going to be going forward? And I only ask that because it seems, and I could be wrong here, but it seems like for the past bunch of years, it's kind of been pinned to growth. That value's really gotten the short end of the stick for quite a long time.
And no, that's right. I mean, you could be in the growth side of the equation for a year or a year and a half or two, and then it rotates into value for 6 months, 8 months, a year and a half. Then it rotates back to value. So it's not this isn't something that rotates like every week. It takes time for these changes to occur, and so we're looking for the macro changes of value versus growth. But there's enough historical work there and evidence that's there that gives us a pretty good model to work off of.
Okay. All right. Well, so maybe we should just pull up the S&P and get the technicals out of the way, especially since we're pressed on time here. Um, but what do you think now? Okay, we're in a new year. We're not that far from 7,000. The momentum here is up and to the right. Not quite as strong as it was, for what, July through September of last year.
Right.
But it's still, it still doesn't look like we've reached any sort of technical peak in the market yet, but correct me if my assumption's wrong.
No, it's right. I mean, take a look at the chart of the S&P. We're bumping up. It's interesting. We've set some new all-time highs this year, but we haven't actually closed above intraday highs. So, we're kind of bumping up to the top of this kind of trading range. And again, we're looking back here, you've got a kind of a nice flat top to the markets, but it's creeping up. So you're kind of creating this kind of rising wedge that's bullish. So a breakout above 7,000, you should get a little bit of relative momentum behind the market. So, we're not overbought. You look at relative strength, it's improving, but it's not overbought. Momentum signals are, kind of in a good average range. They're not overbought either. So there's some room for this market to get some legs underneath it. But, we've got some work to do. First of all, we've had basically, 8 straight months in a row where markets have been positive. That's a very long stretch. So, having a month or two where you get some consolidation or a bit of a contraction even would not be surprising at all. Say the last half of this month, we have a 3 to 5% correction for, whatever reason. That would be totally unsurprising given this massive run we had from those April lows. You should expect probably this year in 2026 at least 2 5% corrections and probably a 10% sometime this summer would not be surprising at all. But given those opportunities, those will be some good spots to add to exposure, increase your equity, kind of risk profile, so to speak. Markets should kind of try to push their way higher, at least here over the next few months, because again, momentum's in place, earnings still look good, economic growth is okay, nothing going wrong there. We can talk about the employment data. It was weak. That's certainly a concern. But what markets are focusing on is that weak employment data means the Fed's going to remain easy, and that's going to provide more monetary accommodation. Buybacks are going to be about 1.2 trillion this year. That'll be another strong support for markets. So there's not a lot of catalyst right now for a big major reversion, but that doesn't mean we're not going to have some corrections along the way.
Okay. So let me ask you this. So let's talk about the jobs for a second. We got the ADP and the payrolls this week for December. Both were sort of slightly less than expected, but not a ton, right?
Right.
So definitely, not warning bells or anything like that. And on the unemployment rate, it actually dropped a tenth of a percent to 4.4%. So to your point, Lance, it's kind of almost like a Goldilocks result for the way that Wall Street likes to look at things, right? It's not bad, so we'll feel good about that. But it's bad enough, it's weak enough that the Fed is likely to continue its easing, right? Which, of course, is what Wall Street wants, right?
Well, I mean, if you take a look at full-time employment versus the working age population, that's declining pretty sharply. And that certainly doesn't suggest that you've got a roaring economic backdrop, right? By any stretch of the imagination.
Well,
Printing out 50, go ahead.
true, but let me just mention this so you can include it in the rest of your answer. GDP has for GDPNow has been sharply revised up, and I know there's some reasons for that, but GDP growth is not coming down, and in fact, there looks like there could be catalysts to the upside. Some of the things we're seeing in the GDPNow data, and then you and I talked last week about at least the administration saying, look, there's a lot of things that are coming, and we're going to talk about some of that stuff today. Could we actually have a strengthening economy that's not paired with job growth,
Yeah.
right? Whether
Yeah, it's not,
AI or whatever just keeps things muted. Not bad, not mass, total firings like we've seen in past recessions, but just hey, this economy is beginning to warm up, but that doesn't necessarily mean that the employers are going to start hiring, in robustly anytime soon.
right. Okay, but it's all fine. That's right. The GDP now number was revised sharply up because you had a massive surge in net exports because of gold exports alone, right? So you had this massive surge, a historical surge in gold being exported out of the U.S. So that gave a massive bump to the trade, the net export issue in GDP, which gave it that massive jump. That's why it doubled. That's not a sign of economic prosperity at all, right? That's a one-off anomaly. We saw that same anomaly back earlier this year. We saw a big drop in GDP because of front-running tariffs, and that was a big trade deficit issue. And we saw the net export number really be the big contributor to that drop in the first quarter, and then it came roaring back in the second quarter because that was all reversed after tariffs. So you're seeing the same exact impact now. But
Sorry,
what
but if you back out that gold bump, I think the GDP growth is still solid, right? It's not like it's
no, no,
weak
it's still
without it, right?
solid. It's about 3%, right, on a quarterly. Now you got to remember how GDP also and now GDP now is also reported. They're taking their number and multiplying it by four, right?
Right.
So they're taking the quarterly number. So say it's 3%. You have to take that number and divide it by four because that's what the quarterly GDP actually is. So again, it's just assuming that when you read that number, GDP 3% or 5%, whatever, it's assuming that every single quarter going forward is going to be exactly the same as this quarter, which is not really a great way to look at data because data doesn't work. But it's it makes for great headlines. But the bigger point that you're missing is that you don't want economic growth without employment because that
I'm
means
not
you don't.
missing.
Right.
I know I agree with you there. I'm just saying that might happen this year, right?
Well, yeah, it might happen, but that doesn't increase earnings, right? And so at the end of the day, what we want is we want earnings to grow for corporations. That comes from economic activity. And if I'm not putting people to work, then I don't have as much money spent in the economy. Yes, I'm going to have some one-offs this year that's going to keep economic growth supported. You got a lot of AI spending on capex, a lot of business investment, those type of things. But that's not going to lead to broader economic prosperity if we don't have job growth to go along with it. And what we need more importantly than just job growth is we need full-time employment that pays benefits and allows people to support families and those type of things. So yeah, we can have economic growth that looks good on the surface, but underneath you get a deterioration in economic prosperity that eventually flows into corporate earnings.
Okay. So I mean I agree with all that. And look, I'm hoping both for a stronger economy that comes with greater real wage growth, right? Um, it's interesting. What I'm trying to do though is just prepare people for some of the
Yeah.
possibilities of this year. And you and I talked last time about how we could have a year of strong economic growth, but poorly performing markets, right? They don't have to be correlated. And obviously, when valuations are as high as they are right now, the risk of that happening is higher than normal, right? We have this K-shaped economy as well. And, as long as asset prices don't uh, crater, those who have assets are going to continue to spend. And we just got the holiday spending numbers. Um, we saw that online holiday sales, but I think this is true of all, hit a new record, 258 billion, basically, heavily driven by buy now, pay later, and people responding to discounts. So, not necessarily the healthiest sign there, but to your point about the importance of earnings and whatnot, the spending is still there. And that could continue through the year, driven by that top cohort, right? Again, on average looks great, on median wise doesn't, but GDP only really cares about the average until and unless the bottom 80% really get into tough times.
Well, and again, we talked about this earlier this week on the show, which was that, one of the things that you never do is count the consumer out. And is like, oh my gosh, consumers have so much debt, they're about to tap out and this market's going to crash. The I've been in this market for over 35 years, approaching 40. And I tell you, over the years, what's always amazed me is how consumers can find more money, whether they find it on credit cards, they take out loans, they go sell, their kidneys, whatever it is. Buy now, pay later is, the new thing. But it's always amazing to me is that consumers are always able to find more money to keep spending. And again, it's funny. You and I talk about the K-shaped economy and how things aren't fair. And people can't afford houses or whatever. And a massive function of that is their own financial, kind of habits and what keeps them poor. And what keeps them poor is finding all these alternative measures
Right.
to spend money with.
Right. When
And
they should be tightening the belt and really, yeah.
yeah, but again, it's the the one, and again, this old axiom of Wall Street is never count the consumer out because they'll always surprise you.
Yeah, no, I totally agree. And you know what? I feel like going into credit card debt is like the analogy there is selling your kidney. I think going buy now, pay later, the analogy is like selling your second kidney.
Exactly. It's selling your heart, just
Yeah, it's like eventually, once that's gone, it's gone. Yeah, exactly. By the way, folks, we're kind of laughing through the tears on this one.
yeah.
Um, So let me stick on this just for a second here. So from my perspective, you disagree with me if you're seeing something different. There are a few signs at this point that we're heading off any sort of economic cliff. And look, I'm the first guy to say, to give you the long list of reasons why we could end up falling off one. But to your point, Lance, we have to trade the world as it is, not as the world as we think it should be or wish it were, right? So, so first off, I think we just all have to acknowledge that, right? And so if you're pessimistic about the current economic system and the current markets or whatever, you just want to be eyes wide open, right? So you don't necessarily want to be taking a drastic position. In your case, Lance, that might just be going all into the bunker type of investments, or even more aggressively going short. A guy I know was pinging me yesterday, telling me that he's gone pretty short for March and April. And I'm just basically telling him, man, I hope that works out well for you. But that would make me nervous on that too short of a timeline here. Um, so we're not seeing a ton of signs yet of the wheels coming off, and there are factors, as you and I have discussed, that could make the economy surprise to the upside this year, right? And certainly, if you're listening to the administration, Secretary Bessent, whatever, he'll give you a very thought-through litany of reasons why he thinks the economy is going to be running much hotter at the end of this year than at the beginning. And a lot of this stuff is, he would say, these are the investments that we made through 2025 with all the new policies we passed and all that type of stuff. And I think you count that stuff out at your danger, at your risk, right? I'm not saying they're going to manifest, but I can see how if they do, they'll have the impact that the administration thinks they will. So you've got to have some positioning in your portfolio. Okay, if the administration actually succeeds on that, I got to make sure I'm not steamrolled by that. Now, in addition to what I think they've been trying to do, which is to create things that are going to drive more secular growth, it is increasingly clear, to me at least, that they are willing to do whatever it takes in the near term to try to support the system, goose the system in advance of the midterms, right? So, we're going to get the biggest tax refunds apparently in history this year. That's going to be hitting pretty soon. A lot of that money is going to be spent. It's going to juice the economy. Presumably, and we're still waiting to hear what the Supreme Court's going to say about tariffs, but there's a bunch of tariff revenue that's come in that the president has said, hey, I'm gonna send checks to middle income households with that. If that indeed happens, that's going to have a stimulus effect. We just saw yesterday the president announce that somehow he's going to find somebody to buy 200 billion worth of mortgage-backed securities here, right? So to me, Lance, to me that says, look, the administration's getting really serious about kind of buying votes, for November. And whether I like that, whether I dislike it, and folks, I dislike things that are artificially stimulative. I got to admit that if they do this stuff, it may actually juice both the economy and the markets. So, I got to be eyes wide open to the fact that, yeah, even though I've got some of these concerns, these things, at least in the short term, could overpower them. What do you think?
Oh yeah, no, absolutely. I mean, you just take a look at deregulation. You've got a lot of benefits coming from the one big beautiful bill that'll factor through this year. Tax cuts are one of those. There's a lot of economic support, for the markets, you know, both economically and just fundamentally in the markets for this year. Doesn't mean that things are going to work out fantastic. There's a lot of other things that could come along that could certainly undermine that. But as a good example, let's say the Supreme Court was, so as you and I are talking, it's about 10:30 Central Time here in Texas on Friday.
On Friday.
Friday. The Supreme Court was supposed to rule on tariffs at 10 o'clock this morning. They didn't. They ruled on another issue revolving around prisoners being able to have their sentences reviewed by the Supreme Court. But we didn't get a ruling on tariffs, so that still might come. But see, even if the Supreme Court comes out and rules against tariffs, which is according to Polymarkets anyway, that's a pretty high probability they will rule against the tariffs. Then the question that becomes is, what does the administration do next? Well, Scott Bessent's already said he's got 3 or 4 other avenues to go down to get tariffs, kind of reinstated using some other means. We'll see what happens, but if you repeal the tariffs, it's actually good for companies like Staples and a lot of value companies, manufacturers, et cetera, that do imports and exports on an international basis. That's going to help improve their profit margins because you just removed the tax. So that's going to be good for the markets. We can all debate over the validity of tariffs and whether they're good or bad or indifferent. But just the bottom line is, if you take tariffs off companies, that's going to be a boost to bottom line profitability. So so again, there's a lot of things that are supportive of the markets right now, but that doesn't mean that in 3 months or 6 months something can't crop up that kind of pulls the rug out of underneath the markets. And again, that is the thing. Mind you, all this stuff that you and I are talking about, the market's already factored in, right? There's nothing you're thinking about or I'm thinking about that the market hasn't already thought about. That's the beautiful thing about markets. It's millions and millions of minds all trying to figure out what's going to happen next. So all that's factored in. But the thing that gets the market is something totally unexpected, like, the president standing in the Rose Garden going, hey, look, here's the tariffs on a board. And the markets weren't expecting that at all. So you got a big correction. It'll be some event that causes Wall Street to go, you know what? We're not going to make $330 a year in earnings this year. It's going to be 300. What does that mean for valuations? And that's where you get a price correction in the markets.
Yeah. Well, so what's interesting is I feel like this, so last week when we talked, you basically said that you were going to write kind of a redo or a second version of the piece you wrote at the beginning of last year, right? The Curb Your Enthusiasm thing.
Yep.
I can't remember. You were going to use a different analogy or a different TV show this year.
It's South Park this year.
South Park, okay. But basically making the same case, right?
Mm-hmm.
Which is that you think this year is probably going to be more volatile and um, probably it's going to be a tougher year than say 2023, 2024, right? And even most of 2025, how 2025 played out, right? Um, and similarly to that, or corroboratively of that, I'm finding that the people I interview on this channel, like the really smart people who are really plugged in, they're coming up with very different perspectives on next year. So two people in particular who I definitely place a lot of weight on their analysis. One is Jan van Eck. So he's the president of Van Eck family of funds, right? I mean, they've got ETFs in virtually any asset class that you can think of, right? And Jan kind of sits at the center of the web there, where all that information flow is coming through his desk. So he's got one of the probably most informed perspectives on the securities market than anybody that I know. And Lance, he is really bullish. He just did a presentation that's going to release on his channel the day after this video airs, so that'll be Sunday for folks. And he walks through a bunch of charts and basically gives a pretty compelling reason for why he thinks 2026 is going to be a big risk-on year. And I did the whole thing with him about just statistically, 4 years in a row of great returns is rare and stuff, and he gets it. But he's like, I'm just telling you, looking at all these factors here, they make me pretty darn bullish for the year, right? So very compelling case. Now, a video I just released yesterday was with Michael Howell, who's Mr. Liquidity. And Michael was one of the very first. I think he was the first guy that I knew who really stuck his neck out in October of 2022 and said, guys, it's time to go bullish. And it's largely based upon his framework of global liquidity, and it had bottomed and it had started going back up, and his liquidity cycles run in several year timeframes. And he basically said, the cycle is turned, I think we should be bullish. And he remained bullish all the way up until just now. And he's saying, my data is telling me that the liquidity cycle highly likely peaked in Q4 last year, and we're going to be riding it down for the next couple of years, unless there's a correction that's so severe that it just shortens the cycle. So he's basically saying, look, I'm not necessarily calling for like a crash in 2026. I'm just telling investors it's going to be a disappointing year compared to the previous three great ones that we've had. So my point here is just, it's going to be tough to really predict this year well. And so it's a kind of year where you're really going to have diversification or multiple strategies in place to be able to say, okay, look, if my primary thesis is wrong, I want to make sure that I'm not wrecked because of that. And it's a year where I just think the chances for surprises are higher than normal for all the reasons that you just mentioned and I just mentioned.
Yeah, no, and that's why I think predictions are pretty foolhardy, and we don't make predictions for the year. We just produced our outlook for 2026, which is a range of outcomes that ranges from 5,500 to 8,000. And the whole point of that is that the markets can wind up anywhere in between that range, depending on what comes. And so what's important is just to navigate the markets. It's interesting if you think about how most people invest. They go, oh, I think the market's going to be bullish this year, so I'm all in, growth stocks or whatever. And then things go wrong and they lose a bunch of money.
Right. Or they just have even just the rotation you're talking about, where they
Or
go
even
nowhere
rotation.
because the investors went everywhere,
Exactly.
elsewhere.
Or vice versa, right? They go incredibly short, the market keeps running higher, and they wind up the wrong side. So for us, it's simply like navigating a ship. Is that I'm not just going to get my ship and say, okay, I want to wind up in Alaska and just point the boat in that general direction and hope I get there. You're going to navigate. You've got storms to worry about. You've got obstacles to worry about. You've got a port for fuel, whatever. So
Sandbars, pirates, weather. Yeah.
exactly, always pirates. They're always a problem. So, but yeah, I mean, the goal is that we just have to navigate that ship to our end goal. And as things change, we're going to change our place in the markets. Look, we're overweight equities right now going into the year because we're still bullish on the year. We're still long our Googles and our Metas and our Nvidias. We own those guys. But we've recently added things that are really stupidly boring, like, Altria, which is boring. It just throws off an 8% yield. It's just those type of things. Added a bit of Verizon to the portfolio. It's really boring. It doesn't do anything. It just sits there and throws off yield. That's okay, because if the market does correct, money's going to rotate into those sectors, and that provides us some ballast in the portfolio that we can increase later on if we need to. So yeah, we got a little bit. We're kind of tapping the brake just a smidge, but it's not enough really to slow down the momentum of the car right now.
All right. And sorry, by tapping the brakes, again, you're not diminishing your equity exposure. You're just shifting a bit more of it to these boring, more defensive plays.
Yeah, and very small. I mean, we're still probably 85% growth versus value right now in our primary models. Like I said, depending on the model that you're talking about, but our primary model, we're still about 80% growth in allocation, about 20% value and defensive, and that'll shift, as kind of markets dictate. But right now, there's nothing telling us that growth is falling off a cliff right now, and so we want to stay more exposed to that long side.
Yeah. Okay. So how to transition into this? I guess let me ask you this. Do you have an opinion on international stocks? So right now, India is the fastest growing country in the G20. It's a market that Jan van Eck has been really bullish on for a couple of years. Valuations got pretty rich. So, middle of last year, he was like, I love it still, but I'm not sure if I'm a buyer at these prices. Things have cooled off a little bit. Not necessarily asking you about India, but the rest of the world stocks actually outperformed the S&P last year. Um, do you have a sense as to whether you think that's going to continue this year, given all that growth?
There, so if you take a look, okay, so first of all, you got to break down the world into regions. So you can't just say international versus domestic, because, for instance, the Eurozone is not going to grow at all. They're, way behind the curve on terms of AI and what's going to happen in that growth cycle of AI. Their GDP, they're plagued with years and years, decades of bad monetary and economic policy that have just kind of really destroyed the growth cycle of those countries. And so the Eurozone, quote unquote, will grow around 1% next year, according to the IMF. US GDP growth is going to be closer to 2. You start getting to some of these emerging market countries like India, China, et cetera, their growth rates are going to be a lot higher. But you always have to remember one thing about international. This is the big factor that comes back into all of this. The miss, I should say, the misstatement that's always made is that, well, these countries are cheap relative to the U.S. That's a bad analogy. For 15 years, international markets have vastly underperformed U.S. markets. So again, if you've owned a bunch of international emerging market stocks, yeah, they weren't great last year, but over the last 15 years, just as an example, they just so massively underperformed. They were like a major boat anchor to your boat getting to where you want to go. So it just really dragged on your overall performance. A lot of these countries, and again, as your guest said, India is very rich right now relative to itself. So when you're thinking about investing internationally, I'm certainly not opposed to it at all. I think you have to look at each country that you want to invest in and determine, is it cheap relative to the country itself, not relative to the US. It's irrelevant. It's only, is it cheap or expensive relative to itself. And if you can find a country that's trading very cheaply and they've got good, strong economic prospects, that's probably a good place to put some capital. Unfortunately, I just don't see a lot of those areas in the world right now.
Okay, so obviously, folks, watch the video with Jan to get a little bit more specific on some of the other parts of the world that are catching his attention. But for a second, I know you said you're not thinking of it this way, but just think of it as the rest of the world, right?
Yeah,
And I'm sure there are funds where you can just buy, a mix of
everything.
everything.
Yeah.
Given, again, this is the difference between economic growth and stock market prices. So US outgrowing a lot of other places like the Eurozone, but stocks very richly valued, right?
Mhm.
So with a broad brush, you know, international stocks outperformed the US last year. Do you think that momentum is likely to continue or not this year? Or maybe as a more simple question, what role should they play in a portfolio? Just non-US exposure.
I think you're late to that trade. Momentum will probably carry that international trade maybe a few more months, maybe even the rest of this year. It's very possible. One of my favorite charts to always look at, as I'm sure you've seen it, Adam, is the Callan periodic table of returns.
Yeah.
And so it shows you on these periodic tables, it's like a periodic table of elements, right? But it just shows you, what asset class performed the best last year, all the way down to the worst. And what you'll notice in particular is that, first of all, anything that's at the top of the return structure for 1 or 2 years always winds up at the bottom of the return structure in the subsequent years. So that just always, this is why investors always tend to be wrong, as they chase what was performing at the time it begins to underperform. But internationally,
Usually, I would agree with you. I mean, for too many years recently, the hyperscalers have been up near the top, but yeah,
yeah.
generally
But
you're right.
again, S&P is, again, 2 or 3 years at the top, and then it'll fall, like we had in 2022, right? You had a correction in
Yep.
2022. But the point is that international markets in particular spend less time at the top than they do at the bottom. So, just they outperformed really well last year. Could they do 2 years? Yes, that's not entirely impossible. But I think you're getting, given the economic growth dynamics of those countries, I think you're getting towards the tail end of that run, not the beginning. So just,
Okay.
the point is, if you're going to own them, it's fine to own them. Just make sure you understand your risk profile and how you're building it into your portfolio structure.
Okay. So you said that you are starting to increase slightly right now, but maybe more as the year goes on, TBD, your portfolio into sort of more defensive areas, right? The more boring, less sexy, high income stuff. What about defense stocks? What's your position at RIA with defense stocks? There's a lot of people that are saying, hey, that's where all the money's going, not just in the US, but kind of everywhere internationally. Um, that should play a bigger percentage in the portfolios going forward. What do you think?
No, yeah, we own, for instance, one of the stocks we own in our portfolio is Raytheon Technologies. We've owned that company when it was United Technologies, before Raytheon acquired them. We've owned that company for years, and we've made just a ton of money in that thing. Every time it goes up, we trim it back. It runs up again, we trim it back. The frustrating part has been we've been wanting to actually increase that exposure in the portfolio, but we can't get a good break where that thing will correct enough to allow us a good entry point. So, it's continuing to do well. I like defense companies. I think they're going to continue to do well. So yeah, you need, I wouldn't go massively overexposed in defense stocks. I think everything requires a balance. But yeah, you should definitely probably own some defense stocks in your portfolio.
Okay. All
But,
right. So,
real quick, with that said, all defense stocks are not the same. So make sure you choose wisely.
all right. So two questions on that. One, from a richness, sort of from a multiple standpoint, how is the sector currently trading? And then, okay, Lance, that sounds great. I want to own one of the good defensive stocks. What should I be looking for?
Well, price performance is one. I mean, that's kind of an easy way to look at them. If you start scanning through defense stocks, whether it's Northrop Grumman or General Dynamics, Raytheon Technologies, go right on down the list. You'll see some that have better stock market performance than others. So you kind of want to pick. Don't buy the one that's beaten down when everything else is up, because there's probably a problem with that particular company. And yeah, there's sometimes stocks are cheap for a reason, is the point, right? So just make sure that you're buying the company that's in the right space, whether it's Lockheed Martin, whoever it is. So there's some great companies out there. But then again, at the end of the day, all these stocks are trading pretty rich. They're growing revenues like crazy. Fundamentally, they're very good. So, fundamentals will matter ultimately. But the one thing about defense stocks is, they can be volatile. So, if you're going to own them, understand that, it's not uncommon for defense stocks to trade down 10, 15, 20% and then rally right back to all-time highs. So if you're going to own them, you've got to give them more wiggle room in your portfolio and not, sell out at the first sign that they're going down.
Okay. There was an announcement yesterday, day before, by Trump that basically said he wants to increase the budget for the U.S. military, and I think it was by a good amount. He said he wants to get up to 1.5 trillion. So presumably, I think Wall Street hears that and says, "Okay, should own defensive stocks." That's even more money coming their way. Okay.
Yeah, no. He said a couple of things. First of all, he said, he's going to ban buybacks and dividends until they get back to producing quicker, producing military equipment faster, and then also repairing equipment faster, which I thought was interesting.
Oh, okay. So that's a negative then for the stock price, right?
Yeah. Well, it was negative for a day, and then the next day they were roaring right back to all-time highs because of the announcement, hey, we want to increase spending. So, yeah, you got to take these things with a grain of salt. Look, I mean, at the end of the day, this president is very much pro-America, America first, increased national security, and that requires a stronger military. So, he's very pro-military, and that's good for the defense sector. And again, that's why we own exposure in that area. We'll probably increase exposure to that area at some point if we can get, like I said, get a decent correction in price. But yeah, again, I think you just have to have exposure there.
Okay, yeah. And I got to say too, it's just crazy making. I mean, I spend a lot of time on X during the day, and Trump just throws these things out so fast and furious. And like within the span of 24 hours, he delivered something I've been asking for years, right?
Yep.
Which was, hey, let's get big institutional money out of the single family home market. And I was like, God, thank God, I've been begging for that, right? And then less than 24 hours later, and then I want to buy 200 billion of mortgage-backed securities. I was like, come on, it's like the worst thing ever. So, it's bananas.
Got one step forward, one step back, right? So,
Well, and look, and that's why, I mean, really, that's why I brought that up earlier. Like, I just sort of see that as increasingly like that tariff checks to households, whatever, like I'm going to do whatever it takes to try to win the midterms, right? So I would just say be prepared, folks, for lots of things, lots of unnatural acts between now and November.
yeah, and again, I see where his intentions are. I mean, and they're good intentions, right? It's like I'm gonna buy back $200 billion worth of mortgage-backed securities. We're gonna get rates down so people can afford to go buy a home. Well, the problem is
But
that
it's not. It's going to raise prices. It's going to keep that
exactly, but
affordability problem there. It's
exactly,
a gift to existing homeowners.
exactly. So, the problem is that it's a well-intentioned, but this is most economic policy that comes
But I
out.
don't know if it is well intentioned. I think he's just like, I don't want to have a housing price correction before the midterms. That's going to be bad.
There's nothing on the horizon saying that a house price correction is even coming. There's nothing out there. Supply and
Oh,
demand.
God. Okay. I disagree on that, but let's not fight this time.
Okay, I'll tell you. Yeah, okay, fine. We can argue about it later. But the point is that ain't going to happen before the midterms. So, again, his goal is to be well intentioned. Hey, and look, to buy votes for midterm, get mortgage rates down, awesome, right? And it sounds great. But the problem with the majority of economic policy that comes out of Washington is it's misguided. This sounds good on the surface, but they don't ever look at the unintended consequences. This is why we had the housing bubble to start with, was because of all the unintended consequences that came from adjustable rate mortgages and no money
Well,
down.
that's my, again, that's why I just hate it so much, which is you're not going
Yeah,
to solve an unaffordability problem caused by too much intervention by more intervention.
exactly. And yeah, and the same thing with checks to households. We know how that turns out. And I don't think he ever sends checks to households. I don't think he can get that pushed through Congress. But you know, that's a terrible idea. We know that if you send checks to households, you're going to create a spike in inflation. You're going to
Right
cause
there with you. Yep.
problems. Again, there's no incentive to do it, and it just makes people poorer at the end of the day because you raise the cost, they spend the money, and then they have no money, but the cost doesn't come down.
Yep.
So everything equalizes at a higher price. It's just bad. These are bad policies that we've been doing for over a decade. And you wonder, you look around, you go, why are we in the situation we're in? It all goes back to the financial crisis. Almost 90% of it is stuff we started doing back in the financial crisis.
Yeah, I mean, there are things before that I could add to the list, but I agree. It
Yeah,
it it
that's what I'm
it
saying.
it
That's the
it, it,
10%,
it, it
90.
built a runaway momentum with the GFC. Yeah, and
Yeah,
everything
absolutely.
we should have done, we didn't, and we tripled down on the stuff that created the problems in the first place. Yeah.
Yep.
So, okay. So, anyways, enough about this. Except just I want to reiterate the folks, like, just prepare yourself. Who knows what the future is going to bring? As Lance said earlier, like Yogi Berra, predictions are hard, especially about the future. But a prediction I think that is easier to make right now is we're going to see more and more of these unnatural acts coming up to November. And like me, you might cheer some and hate the rest, but it's going to be deformative to try to influence the election results. All right. So this is kind of a little bit tied to defense stocks, but Lance, do you see any material impact that we should be aware of some of the fast-changing geopolitical developments that are out there? And I know in general you think the markets don't really care because they've largely priced this stuff in, but very recently we had Maduro removed. Probably markets don't care so much about that specifically, but of course it has economic potential. Well, it has economic implications and certainly potentially around the oil industry in the future. We are, I think, in real time seeing a growing potential that the regime in Iran might be replaced. And I'm definitely rooting for that. I think if the people could throw off the yoke of that oppressive theocracy, that would be great for them and great for the world. Again, potential economic implications. Again, potentially big ones for oil. If all of a sudden Iran becomes friendly again and their oil stops getting sanctioned and all that stuff, hopefully at some point this year, there's peace negotiated in Ukraine. Again, potential material economic implications there if Russia starts doing business with the rest of the world again and Russia oil stops being sanctioned. Um, so you and I
All,
have
all,
been talking,
all this,
pardon?
by the way, all this, by the way, is bad for oil, right?
Well, so I was going to say, you and I have been talking about how, hey, maybe this is the time to get into energy and oil because it's been depressed and all that stuff. But these are potential, big headwinds in front of it.
Yeah.
So
I mean, you're talking about potential big increase in supply of oil. So, but again, like Venezuela, it's going to take years.
it's going to take years to get their oil, yeah, production up.
So, and they're 0.8% of global oil production right now. So that's a non-mover. But your points about Iran and Russia are much more, near-term events. If those turned out, that could bring more supply of oil to markets, depress oil prices, that bring inflation down. So everybody kind of root for that. But certainly not going to be good for energy stocks, at least near term.
So are you making any decisions right now, given all of this, or are you just in the watch and see mode?
Still watch and see. I mean, I'm still in the camp that I think we can see four in the 40s, right? Sub 50, mid 40s in oil. I don't think that's out of the question.
For a
And
sustained period of time or like a blip down into it?
no, it'll be like a gradual decline, and then we'll kind of base and bottom for a while, and then start to, whatever it's causing that, we'll get through that. OPEC will cut production, whatever it is, and we'll start to see oil prices climb back up. I just think you're going to see a better opportunity to buy energy stocks later than right now. Right now you're getting a bump out of energy stocks because of hype over Venezuela. I think that when people realize that's going to be years in the making, then I think that premium goes away and potentially you can buy the ExxonMobil Chevrons a bit cheaper here. Again, a lot of this depends on where oil prices go. And if some dynamic occurs in the next, month or 3 months or 6 months or whatever, that we start seeing an increase in demand for oil and a reduction in supply, which is what's going to drive the price of oil, then we'll start adding more. We have energy exposure now, but that's more tied to the AI data center development stuff. But we'll start adding, more of the kind of the majors in terms of oil and gas, kind of later on, opportunistically.
Okay. I'm just wondering too, like, let's say that this really does depress the price of oil for a couple of years at least, because, for all the reasons we just mentioned, more oil is coming on there. Does that take the wind out of the sails of the high flyers and like the nuclear space right now? Because it might take some of the urgency off the table a little bit. I mean, I know that oil isn't necessarily used for electrical production, but if it's just so damn cheap and plentiful, does it take some of the urgency of moving to some of these other energy sources off?
Yeah. Meta just cut a deal with Vistra and Oklo and one other company. I can't remember. Just caught me. I'm blank at the moment. There's another company. Anyway, Meta just did a pretty big deal with them to generate about 2 gigawatts worth of power from nuclear. But again, the problem with nuclear is it takes a long time to build plants, right? So Oklo is trying to build a plant. It's going to take them, several years to get that built. So that's why some of the energy plays we have now are focused on that behind the meter structure of providing natural gas or liquefied natural gas to data centers for power generation through generators. And that's why we like GE Vernova as an example, because they provide the generators. Um, that I think that's the near term play, and then later we'll start to see where power comes from and who's generating most of that power. But again, there's still the back end problem of this, which is the grid, which we don't have the ability to deliver. Great, you can build a plant, you still got to deliver the power.
Right.
And so one of the big factors is going to be the build out of the infrastructure to deliver the power on a consistent, sustainable basis.
Okay. All right. Well, look, in just that past 4 minutes or so, we have a lot of topics that will probably be interesting rants for us to have going forward, but not for today because we're on a time meter here. So I'm about to ask you about your trades, Lance. Before I do, and then we'll do the rant after that. Is there anything else that's like really burning brightly on your radar that I haven't thought to ask you about yet?
No, it's been boring. The good news is that the first 5 trading days of the year were positive. So as the old Wall Street axiom goes, so goes the first 5 days, so goes the month, so goes the year.
Okay.
So right now we've got one piece of the trifecta in place for
Okay.
a positive year. Now on the other side of
So the
that, we have
Wall Street groundhog didn't see a shadow, so we're feeling
exactly,
good.
but Santa Claus didn't come, right? So when Santa Claus
Well,
fails,
but it's not like he brought coal either, right? I
no.
mean, the markets didn't correct or anything.
But when a failed Santa Claus rally occurs, you generally have more volatility in January and February. So you potentially have a corrective month in February, as an example. Which
Okay.
would, and again, like I said, after 8 months of just positive returns so far,
You'd
you
expect.
know, a negative month would not be surprising at all. Again, that doesn't mean the market crashes, but a 2-3% down month in February, or 2 or 3%, 5% down by the end of this month would be out of the realm of possibility. So, you should be aware of that. But again, if we can, kind of keep our footing here, keep the markets where they are dynamically, everything looks pretty good right now.
Yeah.
Earnings are okay, growth is okay. There's nothing looming out there at the moment that's a big impact, because again, all the narratives go set those off on a shelf somewhere because they don't matter. The only thing that matters is earnings. And what you're looking for is whatever event or catalyst it is that makes Wall Street go, yeah, we're not going to be able to generate those earnings this year. It's going to be less. And now I've got to reprice the market for lower earnings. That's the only thing you need to be watching out for. Everything
Right.
else
And
is nonsense.
yeah, but like I said, holiday online spending was at a record, so we're not seeing stress there yet.
No, exactly.
Yeah.
But you also got to
I mean,
take
we're
that.
seeing a lot of stressed consumers, but it's not impacting the average spending yet. Yeah.
Also take that with a bit of grain of salt as well, because if you actually look at real retail sales, they've been flat now for like 3 years.
Hmm.
So retail sales, when we look at them on a nominal basis. And to understand why that's important is that if you fill up a gas,
If prices go up, even if you're buying the same amount of things, it looks like growth. Yeah,
yeah, exactly. So, it's that's the real issue. Yeah, we're spending more to buy the same amount of stuff,
yeah.
and that's not really economically great
But
either.
on that real basis, it's flatlined. But again, you're not seeing signs yet that it's
No,
deteriorating. Yeah, below the
no, not
baseline.
yet. But the important thing about that is historically is that when you go through a period of where real retail sales are flat, that's normally pre-recessionary.
Right.
So it's
Normally
just,
pre-recessionary, and again, like I said earlier, like I look, trust me, Lance, you know me, I can come up with a whole bunch of concerns around this. But then again, if we give people the biggest tax returns in history, and then maybe potentially in addition to that, give them
yeah,
some tariff checks, that's going to lead to more spending, right?
yeah. I don't think we get the tariff checks, but
Okay. But
tax
maybe
cuts.
it's some other form of relief, right?
Uh, but even Scott Bessent said it'll be a function. The tariff checks will be a function of the tax refunds.
Yep.
So, but
But
again,
forget
I
about
mean,
the tariff check, just record
yeah,
tax refunds.
thousand
So
dollar,
again, like I said, folks, you don't have to like this. You just have to be aware it's going on. Yeah.
$800 to $1,000 estimated refunds this year for most people. Yeah, that's that. They'll go out and buy new TVs.
Yeah. And the sad thing is, they'll take the money and say, "Oh, I've got this free money to spend," and then they'll spend more than that, right? Well, okay, I got $1,000, but the thing I'm going to buy is $1,500. So they're actually spending more money. They're out of pocket more than they otherwise would have been, right? If they hadn't gotten the check in the first place.
Oh,
But
real quick, one thing, and then we'll do our rant. There was a great article in the Wall Street Journal earlier this week, and you and I have talked about before all this speculation, zero data expiration options, and
options, yeah.
leverage. Great article. There was a guy named Captain Condor, which he had this whole group of followers that were trading 0 day to expiration options. They
Condor, because that's a formation with option
Yeah,
pair
yeah.
trades,
So
right?
he was
Yeah.
called Captain Condor, and he was using the old Wall Street method of betting, which is that if you lose money on your bet, you double the next bet. If you lose that bet, you double the next bet,
Okay.
so forth and so on. They lost 50. Basically, he wiped out their entire group. On I think it was on Christmas Eve, if I'm not mistaken. There was
Oh
a guy
God.
actually went onto GoFundMe to ask for money to pay for bills for the month, but lost everything. And so the point is, and we've tried to explain this before, it seems like trading options are a risk-free bet, but when things go wrong, they go horribly wrong really quick. And this group lost like $50 million in total. So don't gamble in the stock
Yeah,
market.
yeah. Again, as we've said, the markets have gotten so used to speculating, sadly, because in
Yeah.
a lot of cases they've been rewarded for it for so long that
Yeah.
everybody is right.
Don't follow some idiot on a video that you're watching on YouTube. I mean, I wouldn't do it.
So it's funny. I mean, we've ranted about this a lot in the past, so I won't do it again here. But just how we have, with both carrot and stick, forced people to become speculators versus investors. Right? It's become cultural now. And I hope I'm not spoiling anything for you, Lance. But you watch Landman, right? Did
Yeah,
did you see did you
I'm
see the
not.
latest episode?
I'm not. So don't spoil it.
Well, okay. All I'll say is there's a scene where they go to in the last one where they go to a casino,
Uh,
and it is very
oh, I
much
saw that episode. Okay, I saw the episode where
okay. Yeah, and so what does she do? She does exactly that, right? Keep doubling down because she's losing, and then they have her win like $300,000 or something like that. And of course, the I'm watching that going like, what a terrible message to send to the American viewing audience that you just have to just keep doubling down when you speculate, right? Yeah,
yeah,
because you're going to
but
end up
that's
like Captain Condor.
exactly
All right, so trades. Have you made any trades over the past week, or as you said, are you still kind of in a wait and see?
the portfolio. Our main flagship portfolios are perfectly fine. We reduced, kind of rebalanced our all weather model a couple of weeks ago. The only thing we did this past week was really the new factor rotation model, which is now up and live and running. So that was started, January what is today? January the 2nd. So that's the only thing that's occurred over the past week.
Okay, so if folks want to go check that out, they can go to simplevisor.com and find that factor model amongst all the other ones you have. Okay, so we're going to get you out of here fairly soon, Lance. I was reflecting on kind of a seminal person in my life, and I'm going to tell my story with them, but it's going to make some key points, some of which are ones that we've touched on in the past, Lance, but I think they're important to remind people of, especially at the beginning of a year. Um, there was a guy who moved into my town when I was a teenager, or town next to me, and He was a longtime Broadway and Hollywood actor. He was a guy, his name was Max Showalter. He also went under the stage name Casey Adams. But he was a character actor, and he worked in just like he worked with everybody. I mean, there wasn't like a star of the silver screen that you could think of that Max didn't have a story with or wasn't a good friend of, right? Really charismatic guy. His most memorable stage role was as Horace Vandergelder in Hello Dolly, right? So he performed more than 3,000 times opposite Carol Channing and Betty Grable and Ethel Merman. He appeared in more than 1,000 television programs. Most folks watching this probably will know him from the film 16 Candles. He was Grandpa Fred in 16 Candles. I had this great gravelly laugh, but just such a great guy. And he ended up settling in the town next to me where I grew up. I grew up in a really small historic village in Connecticut because he had been filming some movie decades ago and kind of fell in love with the area and said, you know, when it's time for me to retire, I want to move there. So we did. And what he started to do to kind of just plug into the town and the community is he started showing, you know, these great movies. So I first met him when he was showing Singing in the Rain, right? So you go to this, you know, little theater. He shows Singing in the Rain. He comes out and he says, "Hey, everybody, you know, wasn't that great?" And we talk about it for a little bit. And he says, "Well, hey, look, do you want to talk to Debbie Reynolds, you know, star of the movie?" And she walks out from behind the screen because he's best buddies with her, right? And you get to just sit there and talk to Debbie Reynolds for the night, right? So he would do that again and again. Really, just a wonderful guy, created a wonderful experience for the community. And he then started directing plays at the local playhouse, and that's kind of how I met him, really. I got to know him well. I got cast in a few of the plays, and so, you know, he directed me, and he really just became kind of a great mentor and really a great friend. So I used to just go to his house, and we'd sit down and talk for hours, and really just kind of the coolest guy. And, you know, what he would do is like, we're all like teenagers in these plays he's putting together. And then, you know, afterwards we'd go to his house and, you know, we'd talk to Mary Martin, right? Or we talked to Katharine Hepburn. It was just ridiculous. I mean, the access that this guy gave us. But anyways, the key story I want to tell here is one of the last times I went to visit him, we're sitting there in the table in his kitchen, and his house was just packed, Lance, with memorabilia, like just playbills and, you know, signed headshots of all the greats, but just things he had picked up in his travels around life. There were things there from the Palace of Versailles. It was just an amazing place to hang out. And his table was always piled with his writings or his uh, you know, letters people had sent him or things like that. And two things really notable about that trip. One, he gave me a book, and the book's called The Artist's Way, which it's a big best-selling book. I'm sure a lot of people watching this video know what it is. And turns out, I can't remember whether it was his niece or a good child of a good friend of his or whatever, but the author of the book, a woman named Julia Cameron, she ended up, you know, kind of falling on some tough times and needed a place to kind of land. And so she went and stayed with Max. And she wrote this book, The Artist's Way, while she was staying with Max. And then it became this massive bestseller. By the way, her name's Julia Cameron, Lance. Her husband is James Cameron, the director of Titanic and whatnot, right? So, you know, she went on to great things after this too. And again, Max was just the kind of guy that played that sort of pivotal role in people's lives. So anyways, we're sitting at his table and he pulls out this, this is back in the days where you had Kodak film that you would send to be developed. And he had a roll of, or, you know, pictures he had just gotten back from getting developed. And he was like, "Oh," he's like, "Adam, you got to see these photos." He's like, I found these cans of film from like, you know, the 50s or the 60s that I didn't realize I had. So I just went and got them developed. So he had starred in the movie Niagara alongside Marilyn Monroe. So I'm looking at these photos and I'm like, oh my God, Max, like these are candids of Marilyn Monroe. Like these things go for auction for a crap ton of money. And he's sitting on this stack of photos of just like hanging out with Marilyn. It was crazy. And then, of course, he started telling me stories of what it was like to film Niagara. And this is the key part that I want to share with folks. So Marilyn Monroe was at her height pretty much then, or zooming up to it. And the movie was made to be a vehicle for her. And they were staying near Niagara Falls as they filmed this. So there were these little bungalows. So he said that what would happen is they'd go to bed, and a little bit after midnight, Marilyn Monroe would creep into his bungalow and crawl into bed with him and just ask him to hold her while she cried. And he was like, you know, she was just a totally unhappy, totally broken person. And, you know, all she wanted was somebody to just give her a safe space to just, or safe spot to land for the night and just comfort her and treat her like a human being. And, you know, him telling me about how she had absolutely everything that she had thought that she wanted, and the world thought that she was it. I mean, this was the height of Marilyn Monroe. Everybody wanted to be like her. And she was absolutely, completely miserable. Just heartbreaking here. So, you know, the message here is a lot of the things that we aspire to culturally, they aren't the brass ring that we think they are. And, you know, a lot of the people that are, you know, we think are the most successful conventionally sometimes are the most unhappy people. And I mentioned in the past that my wife is a couples therapist, and she has a lot of clientele, especially from Silicon Valley, who are extremely wealthy. And in almost, I mean, not in every case, but in a lot of cases, you can point a direct inverse relationship between the amount of money somebody has and the amount of dysfunction they have in their relationships in life. And so the key thing that I just want to sort of mention about this story is yes, this is a wealth channel. Yes, we focus on money and all that type of stuff. But the things that really matter in life, the things that are going to bring you happiness, if that's really your end goal, is to have a happy, fulfilled life, it's not the material trappings. It's not the fortune. It's not the fame. It's the things that Max truly understood, because this is what he focused on, you know, when he moved into my area. It was about community. It was about being in service to others and having a sense of purpose, creating good friends, appreciating nature. He had a little house. It was surrounded by a little apple orchard. He always had I think an English terrier, I'm sorry, English bulldog with him. You know, these dogs with the big bulging eyes and the snuffling snouts and stuff like that. But it just brought him so much happiness, right? These simple pleasures. So anyways, I learned a lot from Max, especially about the type of man that I wanted to be and who I wanted to grow into. He was very influential in shaping that. And, you know, I just really miss him. But anyways, I'll pause here, Lance, because I'm sure you've got stuff to comment on that, but I'd love to hear too, if you had anyone in your life that kind of played a similar role.
Yeah, I mean, you know, look, we've talked about this before, is that, you know, money doesn't buy happiness. It does buy whatever comes in second. But, you know, we
It,
focus a
it helps
lot.
you rent it, as Weird Al Yankovic
Well,
would say.
what I mean by that is and you know, what's important is there's two reasons why people are unhappy, right? So primary reasons. One is you know, they have some dysfunction in their life, whether it's their relationship or whatever it is, jobs, whatever. So they're unhappy about that. But if you're also struggling financially, it just compounds the issue of unhappiness, right? So what I mean by money buys whatever comes in second, it removes that, you know, having money removes that obstacle of just trying to struggle to make ends meet, which is, you know, as we talked about before, two leading causes of divorce are infidelity and finances. And if you've got trouble with finances, it's probably going to lead to infidelity at some point, right? Because you're just trying to find an outlet to be happy or to find
Right.
happiness. And, you know, my life sucks over here, so I'm going to go try this grass over here, which looks to be greener. It isn't, but you know, that's just human nature. Um, you know, so you know, we spend a lot of time on this channel talking about doing the right thing with money, building wealth, you know, taking advantage of markets, those type of things, because it does help provide that underpinning. So underpinning that you've got the ability to focus on what the other problem is that's keeping you unhappy, whether it's relationships or jobs or whatever the fact is. But one of the lessons that took me a long time to learn was is I was always out chasing money. Like ever since I was out of high school, I was running my own businesses. When I was in college, I was doing working in banks, working in finance. I was trying to figure out you know where the money is to be made. And I've always just been that person. This is why I've just been a serial entrepreneur over life, which is starting businesses, growing them, selling them, moving on to the next thing, kind of always chasing that goal. And you know, it just took a long time for me to realize that that wasn't making me happy, and that I had to focus on other things to find what it was that I was missing, which turned out to be family at that point. And it's just when I was younger, I was like, I never wanted kids, I never wanted relationships. It was all about chasing the dollar, and
Hey,
that was
sorry,
not making.
personal question for you to wrap into your answer. If you want to answer it, you can tell me it's none of my business.
None of your
Um,
business.
but your current marriage is your second marriage.
That's correct.
And were some of these lessons you were learning about the balance of money and other things, were those learned through that first marriage?
No, but unfortunately, my first marriage was a function of just a bad partner choice.
Okay.
And there was, you know, it had nothing to do with, well, I shouldn't say that. That's not
I
true.
didn't want to derail us. I was just wondering if it was
No,
relevant
no,
to the
no,
point
no,
you're
no.
making.
There is actually a point to that, which is, you know, and so my work day, as an example, used to be, and my current wife will tell you this as well because she was part of this work schedule, but my work schedule started at 4 in the morning and ended at 11 at night.
Hmm.
And so, my first marriage failed partly, there was a big chunk that was her responsibility, but I have to take responsibility for that as well, is that I was out chasing the dollar, and she didn't understand that while I was doing that, it was affording her the lifestyle that she wanted, but she also wanted me to be there all the time.
Mhm.
And I couldn't do both, right? And so at the same time that she wanted this lifestyle that she wanted to have, which I was having to work to provide, and it required me to be away from the house to work to do that, but that was the conflict, right?
Yep.
The reason my second marriage has worked so well is, and then when we got together, I told her up front, I said, look, this is what I'm doing, this is my goal, and these are the hours that I have to work to do this. And there were reasons my hours were set. I was running a business during the day, doing radio from 4 o'clock to 8 o'clock at night, and doing a national radio show from 10 to 11. That's why I didn't get home till 11. And so I explained this to her, and she's like, okay, I understand. My job, this is why I'm talking about, having a really good partner. If to find happiness, you've got to have a really good partner in life. She says, look, my job is to take care of the house, take care of the kids. So while you're out doing what you have to do, you don't have to worry about what's going on at the house. Then when we come together, you have to commit that when you come home, it's all about me. And I
Mhm.
was like, deal, done. I can do that. And that's why our relationship has worked very well for the last 15 years, is that we've maintained that relationship. She works a full-time job. I work a full-time job. When we meet, though, at the end of the day, work turns off and we just focus on each other, what we're going to do, etc. And that's what makes that relationship work. But that's also where I ultimately found happiness, was finding the right partner that allowed me to be who I was, but then also taught me the benefits of having a strong foundational family structure. And that's where, with the kids and the relationships that I built with my children, the relationships I built with my wife, that's where I found, the happiness for me, right? For me, that's happiness, right? That family unit structure gives me joy, and I enjoy taking them to go do things and enjoying the fruits of labor. But that's why I work so hard, is to provide for them and to do the things that I can for them.
All right. Well, one, thank you for being so transparent, Lance. I know you didn't know I was going to ask you that a question that personal. I'm very happy that you have found yourself to that stage. You're a good guy. You deserve it, and so does your wife and your
Well, it
family.
only took me 47 years to get there, but
But you got there. It's the important part. And you're helping me make my sort of concluding points here, which is, you know, so yes, folks, we talk a lot about money and pursuing the brass ring and what life, but as you know, Max's story about Marilyn tells us, It's not the trappings that matter, right? It's the other things that are much more fulfilling and real. And so my counsel to you all is to really spend some time reflecting on what truly matters to you in your life and really focus on that stuff, right? I mean, spend your time really leaning into that stuff. If you've got someone who changed or influenced the trajectory of your life, like a Max, like Max did for me, if they're still alive, reach out to them and thank them. I mean, there's not a week that doesn't go by that something reminds me of Max, and I just wish that I could tell him now that I'm a full adult, the impact that he had on me. There's a ton of conversations I would love to have with him now that I'm, older and can see life through eyes more similar to his. I'm just so sad that I can't, right? So if you've got someone like that who's still alive, man, reflect back to them at the impact that they've had on you. And then third, ask yourself, most of the viewers here that are watching are 45 and older, and I just know that from all the surveys that we've done. So we're a bit older. So a great question to ask yourself is, well, who can I inspire? Who could you be a Max to in your life? That's a part of I think the privilege that we have at our point, if we've gotten to this age and we've learned some of these life lessons, particularly if we've amassed some sort of success and understand kind of some of the fundamentals of what creates a successful life, how can we pass that along to the next generation, especially as we've talked about a lot in the past, a younger generation that is having a tough time finding their way into the future. So, highly encourage you to think about whose life trajectory you might be able to positively change going forward. And with that said, if you think one of the best ways to improve your life trajectory is to continue to watch Lance Roberts on this channel week in and week out, let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. I tell you, Lance, I tie you to that call to action as best I can every week. If you would like to get some help from a professional financial advisor in terms of positioning your financial wealth for the year ahead, one that might be as full of twists and turns as Lance and I think it might be this year. If you don't already have a good professional financial advisor playing that role for you, well, then consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to even talk to Lance himself and his team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com and the advisors will be in touch with you right away. As a reminder, Andy Scheckman's offer while supplies last to be able to buy junk silver from Miles Franklin for just $1.35 above spot. Supplies are still lasting so far on that. So if you want to take advantage of that, just go to thoughtfulmoney.com/buygold. And again, if you want to join Lance and I in Houston next week, go to realinvestmentadvice.com, click the link at the top of the page, buy your ticket and come join us. Lance, as usual, my friend, I'll give you the last word.
Nope. I really would like to see you in Houston. So like Adam said, come to the conference. It'll be a lot of fun. We've got a few tickets left. So, go ahead and do that sooner rather than later because they are going to go pretty quick. And Adam, looking forward to seeing you next week. Should be a lot of fun.
Yeah, and Lance, I think if you don't mind, we got to record our session on Thursday next week before I hop on the plane so that folks that aren't at the conference have something to watch while we're there.
No, I was going to ask you when you wanted to do it, but yeah, Thursday's fine. I can make that work.
Okay, fantastic. All right. I'll send you a calendar invite after we hop off here, Lance. See you in a week, buddy, and everybody else. Thanks so much for watching.